Welcome back. You're watching Indian Open right here on Bloomberg Quint Live. A better day than yesterday, at least when it comes to the rains and the other Asian global markets. So taking a look at what the rest of Asia has been doing, you've got the Nikkei 225, which is up about 2.3%, Shanghai, which is up 1.75%, and Hang Seng up 0.5% after that big move that we saw in yesterday's session post the announcement that Carrie Lam would be withdrawing the extradition bill. But that's really not stopped the protests, though. Anyway, we'll talk about our markets as well. Yesterday saw that pick up, some short covering in the system. FIs are still at bay, so that's probably not a very positive cue. But what's been happening in the derivative space in greater detail? Let's go across to Navneet, who's standing by. Navneet, good morning.
Good morning to both of you. Well, there is some global optimism that we can see. Let's see if our markets can take cues from that. But yesterday, the last rally that we saw was primarily on account of short covering, and that's clearly visible if you look at the index futures. Nifty futures open interest was down about 3 to 3.5%. Mild bit of uptick when it came to premium levels as well. And looking at the bank Nifty, where more of positions were added in the last few sessions, that too saw unwinding of about 5%. Premium went up to almost about 94 to 95 points. But important cue was about the volatility cooling off. So India volatility index cooled off about 4 to 4.5%. Looking at the options data, today is Thursday. You will have the weekly options expiry. Expect a bit of volatility, but what's the range? You can watch out at least on Nifty, 10,800 put and the 11,000 call. Now, these are the two strikes where maximum open interest is right now. And yesterday, if you were playing a straddle on this strike, the combined premium is somewhere about 100 points. So the range, at least that the traders will be watching out, will be between 10,800 on the downside to about 11,000 on the upside. And yesterday, particularly, you did see the 10,800 strike where both were active on the call and the put side. Moving on to stock futures then, which were the stocks active yesterday. BEL for the second straight session ended in positive, was up about 5 to 5.5%. Long position seen on the future side. Maruti was the top loser in the index. Fresh shorting was seen on that. Escorts was down about 7 to 7.5%. Short positions was seen for this one as well. And short covering seen for Steel Authority. While the FI sold into the cash segment, some cues coming in on the index futures. As I mentioned, it was a short covering rally. Unwinding seen for both longs as well as shorts. More, in fact, 19,000 contracts were unwound. And on the option side, ahead of expiry, there were more positions taken in the long side because more contracts were added on the call long as well as the put short side. With that, it's back to you guys.
All right, Navneet, thanks very much for that. That's a quick wrap on the futures and options space. And remember, today is the weekly expiry, so you're going to be keeping a close eye out on all of those cues. Parthiv Shah, director at TRACOM Stockbrokers, he's joining us right now on the show. Parthiv, a very good morning to you. Really running out of cues here now for the equity markets and purely focused on what's been happening on the globe now, pinning our hopes that there was some conclusion with regards to the October meeting for the trade war talks, some good news from Hong Kong. But with regards to our own equity markets, how are you placed?
Good morning, Devina. Devina, as they very rightly say, that some of the best investment opportunities arises during a bear market or during a point in time where the economy is not at all looking good. What we are trying to do is, and what we are really working hard on is, trying to find companies which are not giving up just because the economy is bad. Rather, I would say there are a lot of smart business houses in our country which are taking, a lot of advantage of this slowdown, and advantage in terms of they're trying to reposition their products or services. And I think they know for the fact that a lot of their competition is going down. And I think it will be very hard for them to try and spend money on R&D, try and spend money on new product innovations, try and spend money on aggressive marketing. And that's where these select companies, where I believe that, they certainly have the cash-rich balance sheet on their hands to spend their way out from this particular economic slowdown. And trust me, I think these companies tend to become even more leaner and meaner, rather, I would say, in terms of trying to steal market share from their peers. And once this slowdown is over, and once we see the economic cycle again reviving, I think these are the companies which get a huge premium in this market. So I think it's a difficult homework to do, but I believe in each sector, there will certainly be such type of a market leader, such type of an innovator, which I think 3 years down the line, if we were to see, if they are in our portfolios, I think they'll certainly do a lot good in terms of beating this slowdown and also creating a lot of alpha. So yes, no doubt there is constant daily news regarding some global event, regarding the Trump tweets, regarding the Hong Kong protests, or even for that matter, domestically also we're hearing a lot of chatter about slowdown. But I think one will have to not get afraid with all of that, still focus on our core portfolios, because I still believe from here, equities will be the best asset class to own over the next 3 to 5 years. I agree it's a very bold statement to make in such a scenario and such a time, but I think it's only these times which I think give us the best opportunities. And also I would like to give one data point. The large cap returns in terms of indices in the last 7 years have been a meager 5.8%. And that is reflective of the fact what the earnings have done. So I have no doubts that next 5-10 years are going to be a lot better from any historical standpoint. They're certainly going to be a lot better than 5.8% CAGR. So opportunity certainly lies ahead, and we are very confident even in current scenario.
Parthiv, the Chinese economic data was positive. There is talks this morning of maybe one more attempt at a trade truce, which might lead commodities higher. Are you, even for a tactical reason, buying into any of the commodity names, ferrous or non-ferrous? And if so, which stock looks the best placed?
See, I think, again, Neeraj, coming back to the same thesis, generally they say that the best time to buy these commodity stocks, whether you talk of ferrous or non-ferrous, is at a point in time where their profit margins are at the lowest. And I still believe that couple of next 2 quarters, we might land up seeing these companies not performing well. But the key question to ask is, say a market leader in the steel sector, someone like JSW Steel, which is corrected from levels of 330 to almost downtrodden levels of 200, 220. I think, does it make good sense to start thinking about these companies here? I certainly do believe yes. I think, see, very frankly speaking, these are cost leaders, and this slowdown even makes them more efficient in terms of reducing their costs and trying to focus on more value-added products. Yes, there is auto slowdown and all the slowdown in the economy, but is it going to be like lasting forever? The answer is no. That's the reason why you're getting such great companies, great capital allocators at 4 times EV EBITDA multiples. So I think, say, in the steel industry, I think we will be very confident on now starting to buy aggressively into names like JSW Steel. I think India is one country where I think one is certainly looking that the overall metal sector will grow over the next 5-7 years at a CAGR rate of 5 to 6%. That is going to be the fastest growing metals country all over the world. So I believe that there should be some allocation in the commodity space in one's portfolio. It's very difficult to have a right entry and exit, but these are the times where the profit margins are the lowest, is the best time to start investing into these companies.
Right. Parthiv, do you track Bharat Forge, Class 8 truck sales in the US? Once again dipping, I think 80% down year on year. Month on month, though, there's been a slight uptick, but June was down massively. July again went down to about 9,800 units from 13,000 in June. And now we're somewhere closer to those levels yet again. Do you feel that this could be, this could have a prolonged negative impact on the stock?
See, certainly, Devin, I think that's really hammered. That's been the reason why the stock has hammered. But very frankly speaking, it's not the business from the Class 8 trucks that Bharat Forge gets its 100% revenue out of. No doubt, I think it's a huge pie of its overall revenue, but still, I think that slowdown has had its impact on Bharat Forge. But if you hear the credible management commentary, I think they are never, seeming to be very disturbed with the way this Class 8 truck data has panned out. Rather, they are talking about the fact that the company is continuously spending to innovate and also trying to move out of automotive business, not exactly move out, but I think have a bigger share of non-automotive business, which can be key going ahead. So I think I have not seen Bharat Forge reporting results where the margins would have collapsed or any major downtrend in their revenues. No doubt the stock has really kind of come down a lot. And I again believe this is a quality engineering name. They are one of the best in terms of the forging abilities in the world. And I think at these levels and these valuations, I think it is certainly compelling. One will have to wait. It's not going to be like a V-shaped recovery. But 3 to 4 years down the line, I think this company, I believe, will be a lot higher than the current market price.
Well, the question mark would be, Would it be Bharat Forge or would it be something else within the auto ancillary space that also looks good? We'll talk to Parthiv about that. Time now to get in our research team on the research huddle to talk about the key stocks that you should monitor today based on the news that have come out on them, and maybe some brokerage notes that have come out as well. Nikki and Somit join in to talk about that. Good morning to both of you. Somit, let's start off with you first.
I'll start off with the brokerages. The first one is on agriculture sector, where Phillip Capital has come out with this initiating note on. They have talked about various segments in the agriculture sector. So firstly, it's the agri inputs. Now they're saying that though the business is seasonal for these companies, it is growing at a strong rate. For the fertilizer segment, it says that the DBT and balanced nutrient usage are the game changers for this segment. And they also say that the leaders in these particular segments are best placed to gain from structural and the policy changes that are currently happening in this sector. Now for Coromandel International, they have initiated a buy rating with the target price of 500 rupees. For Chambal Fertilizer, they have initiated a buy rating with a target price of 200 rupees. For PI Industries, it's a buy rating with a target price of 1,350. And for UPL, again, it's a buy rating with a target price of 730. The second one is on Motherson Sumi, where HSBC has maintained its buy rating on the stock but has cut the target price to 115 from 170. Now they are saying that the rapidly slowing domestic market and the declining global car demand has prompted them to lower their earnings estimate, and they have cut their earnings estimate by nearly 34 to 37% for FY20 and FY21. However, going forward, a revival of the greenfield plants of Motherson Sumi could significantly drive the earnings growth for this company, says the brokerage. Now, currently the losses from these plants are nearly 30 to 40% of the company's consolidated EBITDA, and a revival in these plants would drive the earnings growth and would be the key trigger for Motherson Sumi going forward. Lastly, they have maintained their buy rating on the back of favorable risk reward and the 8% dividend yield that they're seeing for financial year 2021.
Okay, we'll watch out for some of these stocks as well, and more brokerage notes coming your way later on. But Nikki, what about the key stocks in news today?
A couple of them, 5 to 6. Wipro, I'll start off first, which is a tad positive development coming in for the counter. The company has secured a 7-year contract worth around $300 million from ICICI Bank to provide digital services. Earlier vendor was Vara Infotech, which was now bought out by Wipro at a price of around 321 crore. Two metal names are expected to be in focus. Although for Hindalco, I don't see much of a reaction out there. Department of Justice has filed a civil antitrust lawsuit seeking to block Novelis' proposed acquisition of Alris. But then Novelis in its press release has clearly stated that they don't believe that the case is without merit, and they say that they're expected to purchase or close the deal on that expected timeline of around Jan 21, 2020. Which is the same timeline that they reiterated earlier. NMDC, we're expecting some sort of negative reaction coming in on the counter on account of the weak performance that is shown for the month of August. Production has come down by 3% year-on-year basis. Sales volume, that has declined significantly by as much as 36% on account of the production disruption that we're seeing in Karnataka. Equitas Holding, where in terms of the composite scheme of arrangement with Equitas Small Finance Bank, that has sought the company has sought an RBI extension on listing of shares. Now remember, September 4th they're supposed to do this. They've informed exchanges also about it, and now the exchanges await SEBI approval on this one. MCX, which has signed an MOU with China's Zhangjiang Commodity Exchange for cooperation and exchange of information. Well, for Engineers India, this could turn out to be positive because it cancelled plan to acquire Project and Development India. Now this is a PSU that we're talking about, and the certain conditions have not been met. And this company reportedly has been reporting losses back to back. Few auto ancillaries names in focus: Bharat Forge, Ramkrishna Forging, and GNA Axles. North America Class 8 truck orders for August, that slipped by as much as 80% year-on-year and 6% month-on-month basis.
Thanks a lot for that, Nikki. So those are a few stocks that you need to monitor in the session today. And of course, so watch out for some financial names as well. Maybe, just maybe, there are some brokerage upgrades that have come in. There's also this news of the loans getting benchmarked to an external rate from October 1st, the deadline. So all of those things to be monitored in the session today. Parthiv, just a quick thought. We just did an annual report analysis of Bajaj Finance for FY19. All seem to be hunky-dory. Goldman Sachs has upgraded the stock today at 3250. Does it provide a bang for the buck, or would you choose another NBFC over a Bajaj Finance currently? If you had a choice to invest only in one NBFC, would it be Bajaj Finance? Would it be something else?
as compared to Bajaj Finance, just purely because of the current valuations. And trust me, I think anybody holding Bajaj Finance, I would still suggest just hold on to it. But somebody putting in fresh money into an NBFC, I think my preference certainly will be with HDFC Limited. See, again, Neeraj, the same thesis. A company like HDFC Limited is into the housing finance lending, and see the scenario of most of its peers in this industry. I think they are right now at this juncture not even capable to grow their loan book by more than 5-7%. And even if they do so, I think it will be still a good scenario. And here is a government which is constantly talking about affordable housing and wanting the credit flow to improve, at least if not in any other sector, but in the housing sector. In which case, a very, very prudent lender like HDFC Limited, which is sitting on huge surplus in terms of capital adequacy, can raise funds at the lowest rates in the industry. And with the repo rates also coming down, they will certainly be at a huge advantage to select their customers. They'll be at an advantage to take a lot of market share from their customers and take cream of the business. So I'm extremely bullish on HDFC Limited, purely based on valuations. And there's always this chatter about HDFC Limited being very expensive. But if we were to take all its subsidiary valuations, not at the current book value, but at the quoted prices, then I think the core business is available at 1.8 times price to book multiple, which I believe is not at all expensive for a very prudent lender like HDFC Limited. So as compared to Bajaj Finance, the only other quality stock that I could suggest would be HDFC Limited. Just hold on to this theme for the next 5 years. I'm very confident great returns would be made.
All right, stay on with us, Parthiv. We're coming back to you to get in some thoughts from stocks that you like as well. But Abhijit Phatak, director at Definedge Solutions, is joining us right now on the show. Abhijit, thanks very much for taking out the time. Let's talk about the index. Today is the weekly expiry, options expiry. How would you position ahead of that?
Good morning. Yeah, Nifty seems to have made a short-term bottom at least yesterday. And when it trades well above 10,900, I expect it to go towards 11,050. I'm not sure whether it will go today, but because today is the expiry. But in the coming days, I'm expecting 11,100 or 150 on Nifty.
All right. Nifty Bank, do you have a call on that?
Yeah, Nifty Bank also is bullish, and I mean, I'm expecting something like at least 3 to 4% rise in the next 1 week.
Let's talk about your stocks, Abhijit. What are you recommending?
Yeah, I have two long stocks. One is buy sale, which has, though it was weak over the last few months, yesterday it did not crash as much as the other metal stocks. It did not go below the low of the previous month, and now it seems it will gather momentum, and I'm expecting a 5 to 7% rise in sale, maybe towards 37 or 40 also in this month. Okay. The second stock is Aurobindo Pharma, which also is showing some strength in this in the last few days of the weak market. And as long as it is above 590, which is the stop loss, I'm expecting it to go towards 620 and 630.
Yeah, yesterday pharma stocks did look strong. Abhijit, what looked slightly wobbly yesterday were some of the large cap auto names. And the top loser, Maruti Suzuki or a Tata Motors, which is now at 109, which is arguably at its 52-week low, if not around the 52-week low. What do you do with both of these names?
To be honest, Maruti was looking strong in the month of August, but yesterday it just crashed more than 3%, and I wouldn't be a buyer in it unless it goes above the high of yesterday and settles comfortably over that. In fact, Tata Motors looked a lot less weaker. I wouldn't say strong, less weaker than Maruti. So I would be looking more at Tata Motors to go long than at Maruti at this stage.
Wow, you'd go. Sorry, did I hear you say you would look to go long on Tata Motors?
Yes, above 112.
Above 112. Okay. You know, it's an interesting thought out there. Parthiv, for the longest time, anybody who's bought Tata Motors, fundamentally I'm saying, with the belief that valuations are starting to look a lot of, I mean, you know, so many times you've heard there's the cheapest index stock, etc., and every time it's only destroyed well. Fundamentally, does Tata Motors provide value, if it's possible to ascertain that also, at 109, or would you just leave it alone?
See, unfortunately, Neeraj, Tata Motors becomes a value trap because all the value or the fundamental call happens based on forward earnings. And the forward earnings are certainly tracked based on how especially JLR reports their monthly sales, their wholesale sales, their retail sales. And I think there's always a hope that the Chinese market, where at one point in time they used to deliver 30% of their JLR sales, would stabilize, would improve. That's not happening. No doubt the last quarter was slightly shade better, I would say. There's a lot of hope about, once the Brexit thing, whenever it is over, I think the sales in the European markets would also stabilize. That's certainly not looking it's happening. And there's a lot of phase out of diesel vehicles in the European markets and a lot of move towards hybrid biofuels and more importantly, the talk about EVs, where I think there's a small presence via iPace. And even the US markets, which has been like the silver lining for JLR, but still I think it's not been growing at higher double digits. So I think one thing is for sure, Tata Motors as a share, irrespective of whatever valuations, fundamentals that we talk about, it's not going to move till market gets a consensus view in terms of JLR sales now not slowing down, stabilizing, and more importantly, starting to improve, which at this juncture and especially in the distant future doesn't look like it's going to happen looking at the world scenario. So I think unless and until we see green shoots in JLR's numbers, I don't see a reason why Tata Motors, yeah, from here it could just bounce back 20-30% and from the bottom it will look like a great returning stock. But fundamentally speaking, unless and until JLR improves, I think it's very hard to be bullish on Tata Motors.
Yeah, in the true sense, I think Tata Motors is connected more towards the recovery in the Chinese economy rather than the Indian economy. 109 for Tata Motors there. Manoj Vayalar, he's the Vice President for Derivatives at Religare Securities. He's joining us right now on the show. Manoj, a very good morning to you. The weekly options expiry today. Ahead of that, what kind of positions can one take?
Good morning. Yeah, this is the first weekly expiry for this contract of September. Now, ideally, we look into a lot of position that is being carried from the August series to the September series. So we feel that the Nifty has actually shown around, if not more, at least a 4.5 lakh in terms of quantity of the net open interest that we have rolled into September. Wherein the Bank Nifty has also induced around 2 more lakhs. Yesterday, if you see the FIR stats also, we have seen a lot of put writing happening. If I'm not mistaken, a good 23,000 odd contracts, and we believe that 10,800 strike for the Nifty and 27,000, 27,200 for the Bank Nifty. These are the strikes where the put options have been sold. There is some amount of buying as well. So we believe that today the expiry can be a good positive one. 10,950 on the Nifty is where the resistance would be. So the simple strategy is you buy Nifty futures close to 10,850 with a stop loss of 10,800. The target is 10,950. For the Bank Nifty, you can use a route or you can use it through a call option. So buying a 27,500 call option, try and buy it between 20 to 25 rupees. The target should be 60 rupees on that, 60.
Okay, got that. And what stocks should we look at, Manoj?
See, stock specific, I guess even yesterday we had seen good buying which is happening in SBI as well, and we are seeing a couple of stocks in the IT sector still maintaining. So HCL Tech, let's say at 1120, it's still a buy. The upside might be till 1168 with a stop loss of 1100. So these are a couple of stocks, SBI and HCL Tech, that we would recommend at this point of time.
HCL Technologies 1125, IT certainly looking in flavor. Let's wait and watch what happens during the course of the day for some of these names. The other bit will be what happens to some of the commodity linked stocks, because crude, base metals, almost everything has rallied overnight yesterday because of the Chinese economic data. And if indeed the conversations around trade talks, they're never conclusive, but they bring about a move in the markets and specific pockets. So maybe that might lead to a further uptick in commodities. So maybe the base metals, maybe some of the crude linked names would all be in focus today. Yeah,
in fact, Parthiv, a quick word from you. Up until now, we've been talking about how some of the spaces with regards to the input prices coming off could start to show a little more shine in terms of being attractive enough to invest in. What would the approach be from this angle, particularly the input cost part?
That is for the commodity sector, you mean?
Yeah, linked to input costs coming off, rubber prices coming off, crude oil was coming up, but now it started to move up. So all of these factors kept in mind. Metal prices were down.
Correct. See, I think frankly speaking, what happens is that a lot of these companies especially say if I have to talk about the input prices, and more importantly, I think we've seen a lot of sensitivity in terms of input prices to gross margins of companies in the paint sector. And I think here is one sector where what we feel is there are these top 3 companies which have continuously taken a lot of market share from many of their peers. And more importantly, I think that's the reason, despite the slowdown, what we are seeing is these companies are growing their volumes by 13-14%. And at this 13-14% volume growth, they are not really sacrificing on their margins. Rather, they are at a better advantage of using their brand and using their strength to penetrate deeper into the market. So yes, no doubt the paint sector, especially likes of Asian Paints and Berger Paints, and Berger Paints is something that we have liked in the past and recommended on your channel. I still believe, I think there's a long way to grow, that in terms of, despite the slowdown, they are growing. Once the slowdown is not there and once things start picking up in terms of the overall pace of the economy, I think these guys are going to do extremely well. And these current trail valuations, which seeming to be expensive, are going to get justified. And things like titanium dioxide and a lot of crude oil related derivatives are a lot cheaper for these guys. No doubt one will have to keep a watch in terms of the currency having declined. I think that will have some impact in terms of many other companies in other sectors where I think they're importing the raw materials, and which could be detrimental for a couple of quarters.
Yep. All right. Manoj, just want to come to you on a few stocks that saw some fresh shorts in yesterday's session. For one, Escorts saw a build-up of fresh shorts, and also a BEL, which saw from fresh longs in yesterday's session. Would you look at any of these?
Well, yes, BEL, I guess, it's been in this range of 88 to around 115 to 112 odd, and more or less, it is in the range. Rather, we have seen good long build-up, which was seen in a couple of banks, as I said, IndusInd Bank, Kotak Bank and SBI. But apart from banks, if you're looking to other sector, I guess Bharat Forge at 380 to 380 is also a good buy. We are expecting at least a 402 to 403 and that, and even I guess we might see some good traction in Wipro as well. 250 to 56 it is trading at right now, so at least a good 3.5% close to 260 to 68 is what we are expecting, that we might see the stock price to trade in the short term.
Okay, Abhijit, do you track any of these PSU banks?
Yes, I'm looking more closely at SBI than the rest, because the SBI was the one which showed great strength yesterday, and expecting SBI to go towards 290 or 300 in this month, in September.
So you would initiate a long at the current prices on SBI, Abhijit, or would you play it via a mix of futures and options?
Current state, I'm not sure, because the stop loss is quite far towards 265. Maybe a 300 or 290 or 300 call option, which I think 300 call is at 2 rupees. That can go towards 5 or 6 in this expiry.
Okay, so maybe use it via the call option and not necessarily the futures price, what Abhijit is recommending for State Bank of India. Parthiv, a stock that was in focus yesterday was Balkrishna Industries. Deep gash at the start, the brokerage downgrade, Macquarie underweight. They believe that the target price could be about 20% lower, and the stock recovered most of those losses as well. Do you fundamentally track Balkrishna, and if so, what's your rationale of either investing in it or staying away from it?
See, I think, Neeraj, very frankly speaking, Balkrishna Industries, they are one of the leaders in the off-road tire markets, and more importantly, their growth is not very dependent on the domestic market, but it's like it's a big proxy to the global growth, and more importantly, global growth in very key sensitive sectors like, say, mining, where there's certainly a slowdown. And I think why I'm saying this is because, say, one of the key customers of Balkrishna Industries could be a company like Caterpillar. And Caterpillar, I think, in terms of their sales of late, they're not been doing great, because their sales are a key proxy to markets like Chinese markets, where there's certainly a slowdown. So in which case, I think no doubt Balkrishna Industries did extremely well, and still it's a great company. They're quite lean in terms of their balance sheet strength. And I think one good thing that happened was they were to do $100 million worth of capex in the American markets, which I think because of the slowdown they are not doing, which is good news for the shareholders, because then there were concerns about how well that capital allocation would be. And more importantly, I think what we are going to witness is that there's going to be a lot of competitive intensity, which will, I think, go up, because Balkrishna Industries is a relatively low cost producer providing similar quality. And I think of late they had been garnering some market share globally in terms of facing big peers in terms of competition. So I think it's going to be very interesting next few years for Balkrishna Industries, where if they successfully in this slowdown are because of their price controls and because of their lower cost advantage are being able to take market share from global giant peers, then I believe it could be a great story. But currently from the trail valuation standpoint, I do believe there's a case that this stock could correct by 10 to 20%, post which I think it would become a very great entry point to hold on to it for the next 3 to 5 years.
Okay, got that. Manoj, we spoke about HCL Tech and a few other IT names as well. What about pharma as a pocket? Just the fact that you would see some impact of what the currency has been doing. Sun Pharma, for one, has been on and off in the news. You've been seeing pretty volatile moves on the counter. It's at 426. Would you be a buyer in Sun Pharma?
See, pharma as a sector, I guess when there was a rollover from the July to the August series, we had seen good buying which is happening. But unfortunately, there is a concept of volume weighted average price which usually works. We do not see the stock price go below the monthly weighted average price where the delivery based buying has happened. So ideally, if that happens, then we see, the stock ends up with distribution, and that is what we are seeing in lot of stocks except Ajanta Pharma, if I may say that. So we are still waiting on pharma as a sector to enter long, or maybe to see buy on dips attitude. But I guess metals is somewhere where we can shift our focus at least in the short term. See, honestly, in this market, still the buying has not come. Even if you see the FIIs are selling a good 17 to 1800 odd crores, and there is some buying in the stock future. So it's a reverse arbitrage where you sell in the cash market and buy in the stock future. So this surge or this buying that we see in the stock futures is where the derivative play comes in, and we try to rope in that. So metals, I guess, even couple of days before we had seen good buying. So I would still recommend buying a JSW Steel at this point of time. So somewhere close to 200 to 212 is where the weighted average price of accumulation is, with a stop loss of let's say 202, a target of close to 222 to 224, at least in the short term is what we are expecting on JSW.
Okay, got that. Gentlemen, just stay on with us. We're about 30 seconds away from market pre-open, and it looks like marginally positive is what we could open up in Q in tandem with what the SGX Nifty has been doing, 10,885. Rest of Asia is heavily in the green. SANS Hang Seng, which had a bulk of its move in yesterday's session itself. So Nikkei 225, which is up about 2.33%. Shanghai is up about 1.5% right now. Individually, taking a look at the SGX Nifty, 23 points higher right now at 10,880. Looking at the pre-open ticks right now on your screens, 100 points higher for the Nifty 50, 395 points higher for the Sensex. We'll wait for these prices to come off. HDFC Bank, the big move there. HDFC Limited, two big heavyweights there at pre-open, stack up at the top. Vedanta is up about 2.5%. Reliance Industries, 1227. Tech Mahindra up 1.5%. Power Grid, IndusInd Bank, Tata Steel, Yes Bank at 60, that's up about 1%. Should see if Wipro has any meaningful moves on the back of that order from ICICI Bank, but let's see. I think that's up about 1.5%, but that's probably in tow with what the rest of the IT pack is also doing. L&T, yesterday's session saw the last minute spur that brought the stock up closer to these levels of about 13.13 odd. From there, the stock cooled off a bit, now at 13.16 at pre-open. Bajaj Finance, the big upgrade, target price uptick as well, closer to 3,800. That's coming from Goldman Sachs. Talk about the details in just a bit, but that's doing okay for itself. Amongst the losers, you've got ICICI Bank, Kotak Mahindra Bank, and other HDFC twins have shifted lower. GAIL, Grasim, BPCL, Infi are down in the session. Closer to about 353 stocks at pre-open are doing okay in the broader market space. 249 stocks are weak, and the currency too has strengthened. So that was what was anticipated. I think 72.21 or 23 was yesterday's close, and that's come off 71.86.
Well, that's long and short of what the markets are doing. So nothing dramatic aside of that. The PSU banks might be correcting. Let's wait and watch. And Muthoot Finance might bounce back. At least the pre-open rates seem to be suggesting that. Watch out for some of the PSU banks though in the session today. We're trying to see companies which have had gains or losses not just in the immediate term, but maybe over the last few days, weeks, a set of stocks that have stood out. And I don't know if they are investable in that sense or no, but the two twins, Hathway and Den, both of which acquired by Reliance, I think they've had a really good run. They're not present in large portfolios, but I think they've done reasonably well over the last 7-8 days. Today there's going to be this announcement of broadband pricing by Reliance Industries. I don't think it causes too much of a disruption in the industry because BSNL is the incumbent with 50% market share. The others, smaller tunes here and there. Bharti Airtel has some presence too. Parthiv, material from a listed investable space perspective, what Reliance Jio does with its broadband pricing?
I think, Neeraj, it is said, if you cannot compete, it's best to collaborate. And here in which case, I think it's not even collaboration, it's more of an acquisition at rock bottom levels that Reliance Jio has done for both these cable companies. And I think that's the key reason why the stocks are still afloat and have done reasonably well, because there is an anticipation that now, with them being part of Reliance Jio, I think they will certainly survive, they will certainly thrive. And more importantly, I think that there's a lot of investor hope that these companies eventually will be integrated into Reliance Jio's framework. But I think we always know for the fact that whenever there's an integration of a very small company to a very big company, the advantage definitely always lies with the big company. So not that I would anyway suggest that, these are the type of companies to start buying or start owning right now. It's, I think, eventually best to wait for, I think, the market leader, which is now Reliance Jio at around almost 45% market share. And the way I think they have penetrated the market, and I think at one point in time, one thought that they have been installing these free, I think, Jio routers at lots of infrastructure entire country and giving free service. Now one realizes that now once they start charging for them, I think no other competition will be able to come in those localities or those places. So they have a fixed annuity sort of a business model going ahead. So I think they're certainly going to do well. There's a lot of demand for data and quality data rather, I would say, and a lot of their peers are right now struggling to improve their network, forget putting any new capex. In which case, I think eventually what we envisage is from Reliance Industries, there will be a segregation of Reliance Jio as a separate company, as a telecom vertical, which will certainly create a lot of value. So I think the only good way to participate in this theme is by buying shares of Reliance Industries, which luckily, because of its core business weakness, has corrected from levels of 1400 to levels of around 1200. I think at 1200, it's a good sum of part valuation buy. And I think not only the digital business, not only the Jio business, but even the retail business, which is growing reasonably well, capturing a lot of market share and expanding, will also create a lot of value once it is unlocked from the parent company. So I think we are bullish on Reliance Industries as a whole, and more importantly for the two businesses that I mentioned.
Okay. Manoj, before we let you go, one question on an insurance company that is now starting to do well. Actually, if you have a view on any of those three, is fine. But I particularly wanted to know about ICICI Prudential.
See, we have seen the stock surge good and there is good buying happening, but then unfortunately, there is something called as an index management or a beta gain in the portfolio that happens, and I'm afraid till the time the Nifty does not cross 11,200 and the Bank Nifty at least at 28,800, it's too early to say that the bottom is made. Yes, as I said, we are seeing some buying from the reverse arbitrage part of the FIs, but that is just used to get a surge. So once the bottom is made, then we need to see if these insurance stocks are maintaining the gain, because as we said, we seen good money which is coming to this stock. If it sustains, only then. So at this point of time, I would not be a buyer of that. I would simply go with the index. As I said, for intraday it would be 10950 as a target and 27,500 call option for a target of 60 rupees would be the prime focus. Stock specific, we would wait for the data to come in. As I said, 11,200 and 28,800, these are the important levels, or the weighted average price of the entire shorts in the last 4 months which has been coming. Once we close above that, then we look into all the stocks and sectors. As of now, we would avoid that stock.
Okay, got that. Manoj, we're going to let you go on that note. Thank you very much for joining us this morning. All right, Goldman Sachs has upgraded Bajaj Finance to a buy. The brokerage cites improving asset quality as one of the key reasons behind the bullish view. Shefali Malik will take us through the other points highlighted in the note. Shefali.
Well, Goldman Sachs is confident on the asset quality of the company as the delinquencies have been under control for them. And they're saying that the loan growth would moderate but would still be stronger than some of the peers. Also, the fact that the company is increasing penetration in the under-penetrated areas, that is going to bode well for them. 55% of their loans are fixed, so they stand to benefit in an environment of falling interest rates. Also, the company would be a key beneficiary of governments and RBI's efforts to enhance credit flow to the sector. So we can expect the cost of funds to come down for them and the margins to improve, according to Goldman Sachs. This despite the fact that the proportion of mortgages is rising in their book. It's now about 29% of their book, and the competition is increasing in this segment. So that is going to put some amount of pricing pressure. But despite that, they think that the margins for the company are going to improve. So they're saying that the stock price has corrected by 12% since the July peak on macro and retail asset quality concerns, and such concerns are clearly overplayed. So they see strong return ratios to be delivered, that can be delivered by the company, mainly driven by strong margin trajectory, higher cross-selling activity and improvement in the cost-to-income ratio. So they've raised the target price for the company by about 2% to about 3,916 rupees per share.
All right, Shefali, thanks very much for that. So that is Bajaj Finance, which is in focus. Remember, the stock has held steady fort, in all this turmoil that we've been seeing across the board and the sell-off within the NBFC space. This is one of the bigger, more heavy-weighted stocks, which actually manages to garner money even at an expensive valuation. So 32.86 for a Bajaj Finance. Target price is way higher than what you're currently seeing at.
Yep, well, it'll be interesting to see what some of the NBFCs have to say with regards to this current guideline of linking floating rate loans to the external benchmark, because from whatever little I understand now, this new loans the guidelines are applicable for new loans taken by individual from banks. So effectively, housing finance companies like HDFC as of now would be excluded. Maybe at some point of time they do get included, if at all, but as of now they don't. But it's a big change in the whole mechanism of what banks are doing with regards to marking their loans rates to external benchmarks. And if this is made compulsory from October 1st, as it has been, even though there are 4 options given, it's a remarkable shift from what it has been, because the RBI has tried to do this in the past, but somehow not been able to get that going. It'll be interesting to get in views from a couple of experts on this as well. We'll try and do that in moments from now. Parthiv, very quickly, while we just wait for our management to join in, your thoughts here? Who gets impacted, who doesn't?
See, I think this is a great move, I believe, Neeraj. And again, that's the key reason why I did name a stock like HDFC Limited. What they have mentioned is they are not going to be aggressive in trying to match the competition, which is like the banks. They will see what the banks do, because they also know that not all banks are kind of going to have a very big comfort in terms of doing this. And I think they have been allowed a spread over the external benchmark. So depending upon the credit profile of the customers that they choose to select, I think they are going to decide the rates. So I think a guy like HDFC Limited having great cost of funds, I believe will be at a very big advantage, because again they have some fixed loans.
Right. Parthiv, we'll have to cut you in there. We've got Mr. Keki Mistry, the Vice Chairman of the country's largest home mortgage lender, HDFC Limited, joining us on the phone line right now. Mr. Mistry, we've had talks of linking loans to external benchmarks. It started in December 2018. The RBI made it voluntary, asked the banks to do it themselves, gave them a deadline of April 1st, 2019. Didn't happen. And now they've come out and said it's mandatory by October 1st. How have you read into this step, and how positive is it?
Well, the way I see it is that when interest rates go down, obviously borrowers will be big beneficiaries. But rates that go down will also at some point of time start going up as economic activity picks up. So the volatility that customers will have in terms of lending rates in the new regime will be a lot higher than what they had in the earlier regime. From a lender's perspective, from the perspective of someone like HDFC, currently this is not applicable to us because this is applicable only to banks. But having said that, our ALM committee will meet in due course, and we will take a call whether we should introduce a product similar to this and keep the option open for a borrower to even take a loan which is benchmarked off a more stable benchmark where rates do not fluctuate that sharply. So we'll take a call on that, and we'll probably see if we can come out with 2 benchmarks.
Which was going to be my next question. They've given them 4 options: the RBI policy repo rate, the government 3-month treasury bill yield, the 5-month treasury bill, and any other benchmark published by the Finance Benchmark of India. Now, within these 4 choices also, the volatility of each of the instruments also varies. So, you know, how does one align then according to that? If there are some banks that go in for the repo.
The way to do it is not to look at whether the rates move sharply or move less sharply. I think the more important thing is to see is how quickly your liabilities and how effectively the liabilities can be shifted to an external benchmark. You can shift assets to an external benchmark only after you shifted liabilities to an external benchmark. So the Treasury people will have to work out which external benchmark is the one which is more stable, where it is easier to shift liabilities, and then that benchmark will be the benchmark that will be used for assets. My off-the-cuff view is that it will be the repo rate, but that's my off-the-cuff view. The Treasury people will have to take a more calculated call.
Mr. Mistry, good morning. Neeraj here. Would rates reduce immediately for existing home loans unless customers are at maybe a higher rate of 10%?
Well, I don't know about that, whether rates will stop. Customers, I guess, may be given a choice to move to a new state, to a new benchmark. But I mean, if I, as an individual, would prefer my cash flows to be more known rather to have a more volatile regime where in the short term rates go up and the long term rates go higher. So, you know, it depends on each customer. It's left to the choice of each customer. So we'll have to see whether we give the option to existing borrowers to switch to a new product if and when we come out with one.
Actually, sorry, that was going to be a question. I know the dynamics are different, but do you think NBFCs would follow suit on their own on a voluntary fashion to such a mechanism?
I can't talk for all NBFCs.
No,
I can
you,
talk
sir?
only for HDFC. I have just mentioned to you in the beginning that our ALM will look at it and see whether we can have an alternate product which is linked to an external benchmark.
Mr. Mistry, one final word from you. You know, transmission was the key issue with regards to, you know, how much the RBI has been cutting and how much is actually being passed on. Does this materially solve that problem?
Obviously it does, but as I explained to you in the beginning, rates that go down will also go up. So when rates go up, the transmission to borrowers in terms of their having to pay a higher rate will also be a fact. Leave it at that, Mr. Mistry. Thank you so much for taking the time out and speaking to us. That's Keki Mistry, Vice Chairman of HDFC. Well, non-committal on what NBFCs would do. The dynamics very different, so difficult to comment whether or not this will happen for NBFCs. Their benchmark borrowing rates materially different from banks. But let's wait and watch. Minutes away from market open. Before we do anything else, let's take in the top call from our expert, Abhijit Phatak. If you had to bet on one stock for the day today, which one would that stock be?
Sale Authority, sale. I'm expecting a big rise. Even yesterday it went up 5%, and today also I'm expecting a good rise in it.
Okay, so you would buy it on open today, Abhijit, I presume?
Stop loss will be a bit lower, maybe near 30, 31, but yes, it is a good long.
Okay, so good long, stop loss at maybe 30 or 31, the current price 32.65. That is Abhijit Phatak's top call for the day. Gentlemen, stay on. We'll just take in opening thoughts from you post market open. I haven't had a chance to really take in Parthiv's top call as well, but here's how the markets are starting off with a bit of a lull, not quite replicating what's happening in the rest of the Asian screen, because the rest of the Asian screen was awash with green, large green, but we don't quite have that. In fact, the Nifty Bank, after the big move yesterday, is starting off in a tempered fashion, marginally lower. What about the mid-cap and the small-cap indices? They did okay in trade yesterday too, but just pull up those two screens, the mid-cap and the small-cap space. About 25 points for the small caps, about 1/3% for the mid-cap space. So again, nothing too dramatic, but yeah, slightly better than what the large caps have done. Bring up the heat map and show you what's moving and what's not. A lot of green, very little red. What's losing out? Let's start with that because there's very little red. ICICI Bank about 1.5% lower. HDFC about 1% lower. HCL Technologies 0.5%, but aside of that, nothing too much. Maruti, the top loser yesterday, starts off about 0.5% lower. ITC is marginally lower as well. What is doing well? ONGC 3.5% higher, NTPC about 3%. Commodities naturally will do well today. By and large, commodities went up in trade because of the strong Chinese economic data yesterday. Talks of trade truce. So Tata Steel, Vedanta, JSW Steel, Coal India, Hindalco, all of them are doing well. Hindalco has possible adverse news, but just that the strength in the commodity move is so strong that all of these stocks will go up. But it's a flattish start, just that the Nifty is a lot better than what it was at open, about 1/3%. Let's wait and watch what happens during the course of the morning. A couple of pockets that I want to highlight before I hand it over to Devina for what's happening at the broader end of the spectrum. And really, the non-index mid-cap focused stocks on the commodity side. So Nalco, JSPL, SAIL, and all of them too start off really well in the session today. So no surprises, just that all of them are starting off as a pack. So that is the first set of stocks that I wanted to highlight. And then the next set of stocks are companies which took a bit of a beating yesterday, and all of them are starting off well. Escorts, and from Advanced Research, Healthcare Global was down 10%, starting off marginally higher. Devina, what are you spotting?
Few other stocks. Bajaj Hindustan continues its gains from yesterday, and today's session also is up about 6.5%. 7-day tally now takes it up to about almost 30%. Then you've got the likes of an NTPC, which has moved up 4.5%, a big move for this stock in today's session. DB Realty, Inox Wind, a few other names there that are doing well. Remember yesterday's session, Inox Wind was spoken about with regards to the short-term ASM framework and the possibility of it entering that. Oil India, that's moved up about 3%. Diwan Housing Finance, that's moved up closer to 3%. Punjab Housing Finance, PNB Housing Finance, PNB itself has moved up in the session. Hindustan Copper, metal name there, that's up about 2.5%. And then the likes of a BHEL should see whether or not a BEL has managed to pull forward the gains it had in yesterday's session. Had a big move yesterday. Today's trade has seen a follow through about 1.5%. Then City Union Finance and some of the other banks are also doing well. What's not doing well? You've got Sterlite Tech. Yesterday was up about 4.5%. Is now back to about 115. United Spirits is losing. LIC Housing Finance is losing. NIT Tech, Heidelberg Cement, Prestige Estate, M&M Financials, that's also down, and United Breweries, that continues to look weak. 739 stocks are advancing, 300 stocks are in the red, but still in terms of the gains on the index, they can reverse at any point. It's not really a big change which could not be reversed. But a quick closing thought from you, Parthiv, anything that you feel you would want to buy into?
Devina, one theme or one sector which has been totally neglected by this market, and despite the fact that now we know for the fact that the monsoons have been great. I think the second half of the monsoon season has been extremely good. All the deficit has been gone, and now we are in a surplus. And that theme, I would like to play with an innovator. And the name of the company is Bayer Crop Science. This is a company which has done terribly bad in the last 1 year, and justifiably so. The stock also has corrected from levels of 4,500 to current levels of around 3,100. And I believe a lot of negativity in terms of whatever problems they face, bad results, is already factored into the price. This is a company that historically has done buybacks at 4,000 rupees. But putting that aside, I think they are innovators, whether it is herbicides, fungicides, pesticides, and more importantly into the hybrid seeds. I think they are market leaders in the rice hybrid seeds, where they have a 44% sort of a market share. And I think now the more important business, which is going to be coming from Monsanto's merger, I think this as a conglomerate is going to be a very, very important company and is going to play a great role in terms of innovation in the agri inputs in the Indian agriculture industry, which certainly can't be avoided with almost 45% of our population involved in it. So I think this is not going to be like a 6-month target or a 6-month stock. This is going to be a stock where investors will have to wait for the next 3 to 5 years. But I believe it can certainly be a good sitting stock in one's portfolio, which will create a lot of wealth over a longer horizon. So certainly I think our bet would be on Bayer Crop Science.
Okay. We leave it at that, Parthiv. Thanks very much for joining us this morning. Also joining in right now, Gautam Chhaochharia. He is the Executive Director and Head of India Research at UBS. He's joining us right now on the show. Gautam, thanks very much for taking out the time. What's the call now at UBS with regards to the overall market momentum, the mood, the external risks that we are facing right now, the challenges globally as well as domestically?
Good morning, everyone. So global. Obviously, we are worried about growth slowing down further. In fact, we see growth slowing down quite sharply globally in fourth quarter, and specifically in the first 2 quarters of next year, given the escalation in the tariff war between US and China. So that's not necessarily looking good for growth per se. it also means that we could have a more dovish Fed, which could support market sentiment beyond fundamentals. So those are the two moving parts globally. Locally, it's interesting. We have seen the policymakers respond to the growth slowdown, and our diagnosis of the growth slowdown is different versus what we keep hearing. In our view, it's a lot more of a negative feedback loop over the last 4 months than anything necessarily structural or cyclical or whatever terms we want to use. And any negative feedback loop which develops, including one of narrative, typically needs some kind of policy intervention. And finally, we are seeing policy intervention over the last few days and weeks. And again, depending on the scale and timing of further policy measures, that will determine the timing of this growth slowdown bottoming out and then shape and pace of recovery. We do expect further policy measures, but it's difficult to quantify as to what exactly will they do. Will they do fiscal stimulus? What aggression they will show in the monetary policy? That will also be key for us to take a view on how growth comes back quickly. But in our economists' view, we do expect growth to bottom out in the first quarter of this fiscal year and slowly start improving. Maybe the worst is in the September quarter, maybe. But otherwise, we do expect growth to bottom out. Whether it recovers back sharply, that will depend on the kind of policy responses we see going ahead from now on.
You know, it's an interesting point, Gautam, you make, and we've been talking to a lot of managements, particularly companies which have, you know, the exposure with regards to consumer goods and consumer durables, particularly anything that's related to consumption, whether it be slightly more discretionary, aside from the big ticket expenses like cars. So even for that matter, decorative paints growing at 15% in terms of volumes. Yesterday we had, you know, consumer durables, you know, two major companies talking about growth at about 8 to 10% come the festive season. You've got some the FMCG companies, essentials particularly, which don't seem to be in a downtrend because ultimately the consumer will spend on essentials. So is it more of just the fact that the sentiment is so beaten down that everything looks like a gloom and doom situation?
So clearly, as you said, it's largely a negative feedback loop. And the simple way to put it is when the NBFC crisis hit last year, we didn't see auto sales going down 20-30% Y&Y. They slowed down from growing in single digits to, say, flattish. And it's only over the last 3-4 months they have collapsed in terms of growing or growing negatively 20-30% Y&Y. Similarly, for all the other consumer baskets, the slowdown has been much more pronounced over the last 3-4 months than earlier. And there's still pockets of the economy like power, steel, etc., which have showed no signs of slowing down. And they're still holding on. So clearly to us, the way we interpret this is over the last 3-4 months, what's happened is the initial impact of NBFC and autos and property has now started to feed into the rest of the economy because the negative impact of NBFCs, etc., were not really resolved, and it didn't really stay isolated and started feeding in. And what's also happened over the last 3-4 months is beyond the fundamental impact of a feedback loop, the narrative loop also has become quite negative, which has also hurt consumer sentiment. And markets obviously are always reflect a more exaggerated version of the underground reality on both sides. And obviously the pessimism in the market is even higher than the underlying fundamentals, primarily because of the disappointment from the new government in the budget. So that's also playing a role. But there is clearly a slowdown. In our view, it's largely a negative feedback loop, which the policymakers are trying to break, and it should help, and we should start seeing a bottoming out of that. But whether we see a recovery back to growth rates which we were seeing over the last 4-5 years, or lower than that, or even higher than the last 4-5 years, that debate is still out there and will depend on the policy measures the government takes in the next few days and weeks.
So what do investors do? Gautam, good morning. Neeraj here. What do investors do in a scenario like this? Where do they park the money? What kind of returns should be the base case estimates for investors from here on? Not just from a 12-month perspective, maybe that is too short right now, maybe from a 24-month perspective.
Good morning, Manoj, sir. Again, for markets, keeping in mind what we discussed about the growth, etc., the risk reward is still not attractive for the markets because the index hasn't really come down that much and the valuations are still rich So at an index level, we would say that the markets are fairly valued and the risk reward is not attractive to buy in here, at least from the next 2 to 4 quarters perspective. Longer term, I won't worry too much about the growth slowdown which we have seen over the last 6 to 12 months as reflecting anything more structural than what markets were hoping for, say, a couple of years back. So I won't worry too much about the long-term fundamentals, specifically in the context of what's happening globally. So the relative growth attractiveness for India should remain intact. But yes, near term, these challenges are there. So depending on the investor's time horizon, if you're looking at next 2 to 4 quarters, risk reward clearly not attractive. If you're looking at long term, then this could be an opportunity to start dipping in. But again, ideally, you could get better opportunities in the short term, given the narrative out there. In terms of positioning, our preference is still for selective large caps. We still underweight small and mid caps. And even with the selective large caps, you have to be very, very careful about individual stock. So we do like retail liability-driven private financials. We do like oil and gas, property, select individual names in the consumption space. We still underweight autos and industrials and mid caps.
Gautam, just one follow-up. What's the premise of this downside scenario target of 9,400 for December 2019? Globally linked, or would it be India's own doing that could lead to this?
It's obviously a mix of both. So if we see global risk-off sentiment continue leading to a lack of foreign inflows or even outflows, and in India we don't see a credible policy response, which means this negative feedback loop continues to develop, or we see a policy response which is at best settles it down but doesn't really drive a recovery, then the market multiples are still rich and could derate from here, and that's what drives a downside scenario.
Okay, you also done something that is similar to what we do, Gautam. I was reading one of the notes that you guys put out. Now we have this series called CFO Leaders, and I think what you've done amongst the things that you've done is this CFO survey, which reflects some pessimism but some silver linings too. Can you tell us, based on that, what's the key finding there that could help from an investment perspective?
So the pessimism is obviously around demand. So demand outlook, rural, urban, and across company sizes is more muted this time versus last year at the same time. So that's clearly a moderation, but not really a surprise. The silver lining was around trends like hiring, for example, including more hiring of permanent labor. So that is holding on reasonably well. There was another silver lining of capacity utilizations picking up across sectors, but again the capex outlook per se remains muted, in fact more muted than last year, reflecting the sentiment out there. The other interesting takeaway from that survey was also around GST. So we're clearly seeing signs of the positive impact of GST in terms of the formalized sector gaining share or benefits in terms of reduced transportation time. Our survey suggests that that's peaked out last year, and they're not seeing any incremental benefits over the last 1 year. In fact, compared to last year, looks like the informal sector is not in as bad a shape as last year. So the formal sector is not seeing the competitive intensity reduce as a benefit of formalization this year compared to last year.
Gautam, just want to ask you, what is so different with regards to the downturn in the market? I mean, the noises even then were there, but it looks like the negativity is just amplified in this market correction, though the Nifty is down about 10% and last time when we saw the correction, the index actually fell more by 15%. But the negative undertone seems to be more this time.
So that's for a couple of reasons, I would say. One is the negativity reflects the high hopes the markets had post the new government coming in after the election. So as always, markets expect a lot of things to happen in the short term. And in that context, the budget was clearly a disappointment for the markets, not just because of, say, a lack of some of the big reforms, but also because of all those tax measures which dampened sentiment. So it's in that context. And second context is also the valuation. So while markets have not sold off so much at the index level, the broad market has. And that reflects the same thing, that they want to be hopeful, but the narrative clearly is pushing them back. So the starting valuations part and the starting expectations part is, I think, what's making the narrative a lot more weaker, while the continued local flows is still helping support the select large caps and therefore the index.
So, while we're looking at the broader market sell-off and the quantum of stocks that have lost out about 70 to 80% of their share value, I mean, that's quite a large number. Doesn't that probably prompt you, if you're looking at, starting to put money into mid caps and small caps, to encourage somebody to say, hey, I mean, this looks like a right opportunity?
So there are a couple of points to be made there, and to explain why we are underweight small mid caps even now, or in fact 3 points. One is, if you look at the individual small mid caps, which are the quality ones which you would like to buy for the longer term, they haven't really come off. In fact, most of them are still trading at high multiples and near the peaks. That's the first point. The second point is, if you look at a broader mid cap, small cap indices, which have come down, reflecting some of the weaker quality names coming off quite sharply, that the relative valuations today versus the large caps looks one of the most attractive in the last 10-12 years. But if you go back before the 07-08 cycle and look at slightly longer term, then the relative valuation doesn't look as attractive. And the relative valuation looks more attractive on forward earnings than trailing earnings, so reflecting the higher hopes inbuilt into mid cap, small cap earnings. So at a bottom-up level, we still don't see enough opportunities at individual stock or broad indices level to really make a call of going overweight. The last point there would also be, typically if you look at stages of market cycles, small mid caps come to the cycle towards the last stage, or just before the last stage of the cycle. You typically see some of the individual large cap stocks do well, then the broader large cap indices doing well, and then the small mid caps come to the party. We're still some time away for that, and typically small mid caps, for them to do well, need a lot more visible and high conviction about the growth outlook, and also the local liquidity and risk appetite should be much higher. Those are still missing. But yeah, if someone is looking at 3 to 5 years, there's always opportunities, and specifically in small mid caps even now.
I wouldn't ask you to crystal ball gaze and tell me a level that you're looking at for the index. But just in terms of, the 1 or 2 things that you think could be a game changer for the market, whether it be on the upside or something, that in risk terms creates a lot of uncertainty with regards to, value at risk. Just the fact that you've seen so much erosion, but that one event could actually worsen the situation.
So I think the global factors, obviously, locally it boils down to policy action. So unlike various stages of market cycle, this time a market direction on both sides will depend on the specific, the scale and the timing of policy measures by both government and RBI. If we see a very, very aggressive rate cutting cycle, or we see a more aggressive policy stance, including on the fiscal side, it could help market come back much more quickly. If the measures don't address the near-term growth concerns, or still are targeted at long term without any clarity about when the growth comes back, then markets could struggle even more from here on.
Okay, Gautam, one set of questions from my end. As we look at the market today, what is doing well, and albeit it's a bit of a bounce, but all the commodity-linked stocks are doing well. ONGC is up about 5%, Coal India, Indian Oil, Vedanta, Tata Steel, JSW Steel. Now, these are bombed out pockets, be it in the private sector or the PSU sector. Are you looking at this side of the market at all? Pockets which have been beaten down completely, and there is, it's as I'm borrowing somebody's term, one day, someday kind of a trade, or one day, someday kind of an investment. Are you doing that at all?
So as a research analyst, we don't do that, obviously, from a 1 day, 2 day kind of trades. But fundamentals wise, we don't look at something if it's a government-owned company in isolation. But yeah, a lot of the PSUs or SOE companies fall into our overweight call on oil and gas sector or power utilities in India, for example. So there we do see opportunities of valuations being attractive in the context of fundamentals which we see playing out.
Yeah, no, what I meant was that at someday or one day in the next few years or next few quarters, these companies might show a turnaround, and therefore are you trying to indeed log on to those pockets at all? My final question, at least from my end, Gautam, and that's on IT. Are you looking at that pocket at all? Somebody cited that because of the fact that the nominal GDP growth is now down to 8%, companies which are not necessarily growing at 15% but at 12% with stable ROCs and ROEs might actually find the filter of a lot of investors. Is that a reasonable argument?
That's a very simplistic argument to presume that 8% nominal GDP is the new trend nominal GDP for India. It's just a one-quarter print as of now. The IT sector obviously has gone through its own cycles. We had been underweight for a long time. We turned neutral a couple of months back, and we haven't changed that stance. It has to be much more stock selective. The sector could work in a more defensive positioning in the Indian context, but also faces global headwinds given the outlook on global growth. So that's the twin challenges or twin drivers for IT right now, and that's what is driving our neutral call in the sector. And the buy-rated name, if at all, would be more an individual stock basis rather than the sector call.
Okay, Gautam, we'll leave it at that. Thanks much for taking the time out and being with us today and giving us your thoughts. Appreciate your time.
Thank you.
For a change, somebody who's not quite bullish on mid caps and small caps, circumspect, if not negative, on that pocket. Anyways, take a break on that note. Up next is the economic slowdown dampening the festive frenzy for air conditioning products, consumer durable products like air conditioners. We speak to Sunil Shankar of Onida and Jasbir Singh of Amber Enterprises on the same.